Okay, welcome to this Q&A. We have Daniel Moore from Propelio joining us live in his amazing studio. And I am envious. Russ is envious as well, but hopefully he's going to teach us some of that at some point. This is a Q&A about our podcast. And so without further ado, Daniel, welcome.
Thanks for having me on here, guys. It's nice to be back with y'all again.
All right, so walk us through now. I'm trying to imagine this as I've gotten interested in real estate. I want to take real estate as my path. We talk about that in our community all the time. Like, okay, I want to stop trading time for money. I want to take control of my finances and I want to weigh out, all right, now I'm going to start on a path.
Mhm.
And what is that path? Some people, they say, well, I want to do real estate. Now I want to figure out which one of those paths or which, you even talked on our podcast about several that could be paths within real estate that I need to focus on. Like we talked about subject twos and wraps and things like that as a current day strategy.
Yes, sir.
So I see Propelio Academy as that way to really get great information to figure out which one is a good fit for me. Now let's
That's a
say
great way to
I've
think of it.
now let's say I've picked one of those and I need now tools to run my business. Is that where the software comes in?
Yeah, so that's where the software comes in. So we provide you the education to learn and apply real estate. And if you choose to use the software system's there and available to you. Part of the software is giving you the ability to run comps, to get access to leads, to go through and create a website for your business. Or one of the key things that I consider to be a viable marketing strategy right now is driving for dollars, going out there and sourcing and going straight into the neighborhoods yourselves. Those are the aspects that Propelio, the software, can actually help you out with. So the Propelio Academy teaches you how to do the real estate investing, and the Propelio software gives you the assistance with the real estate investing.
All right. So I think right now, Daniel, you hit on this during our podcast where we're at a point where you're seeing the market tailing down. You've been telling people going back to, I think you said September or October of last year that they need to start changing their strategy. And a second ago, you pointed toward wraps and subject to as an area for people to learn about to help them make money in a potential down cycle. Can we just break out just a little bit about subject to what that looks like in wraps for someone who knows nothing about it? And I mean, I've been around it a little bit, so I still know very little about how that works. But if I'm a real estate investor or new to real estate investing, why do I need to learn about subject to and wraps? Why is it that those things can make money as opposed to some other different strategy I was using before leading up to this cycle?
That's a great question, and I must lay it with the preface as to why I say subject to and wraps I feel are prevalent right now. If the market does start moving down, people start losing the equity that they had in their home. Let's just say their home was worth $200,000 today, and they have some equity in it. Well, if the values of homes start to drop, any equity that they had in their home is gone. Now, if they have a house and they have no equity in it, what are their options for selling that house? What are their options for getting rid of that house? Well, when you end up in a market cycle where values are likely going to start dropping, when values do start to drop, you're still going to end up with a lot of people, especially in the economic conditions that are unfolding in front of us, that can no longer afford their home. Well, if they can no longer afford their home and their house that was worth $200,000 6 months ago is now worth 170, and they owe 175 on the house, and they just lost their job, so they can't make the house payment, how are they going to sell their home? The real estate agents have fees. They're upside down $5,000. So just to get clear of it, they're going to have to come up with $5,000 plus closing costs, plus any agent's fees that might be involved with that. You are now set up in a situation where an owner has a house that they can no longer afford, they no longer want, but they can no longer sell until you find somebody that understands how subject to investing works. So this is why I think that subject to and wraps are going to be the forefront of an investing strategy over the next 24 months. That taken into consideration, you should really up your knowledge on that. So you can go into the Propelio Academy, watch 18 hours worth of education on subject to and wrap investing. how does a subject to transaction work? And why, as a real estate investor, would I ever consider buying a house for $175,000? It's only worth $170,000. I'll explain you really quickly how a subject to transaction work and why I consider it to be the forefront of investing over the next 2 to 5 years. I will go in and I will pay face value for that house. You owe $175,000, I'll pay you $175,000. But the caveat to that is I intend to use your existing loan that's already in place. I'm not going to pay you $175,000 cash. The only reason I'm willing to pay you $175,000 is because there's already a loan in place for that house. What I will commit to the seller is that I will make the payments for that house from the day that I take it over moving forward. So they are no longer responsible for the payments, but the loan will remain in their name. So to recap that, you give me the title to your house, and I will give you a security instrument saying that I will pay your monthly payments from this day moving forward. I'm going to pause on that. I'm not going to go much deeper on that at this exact second. Any questions on that? Like, that's foreign. Some people misunderstand that with assuming the loan. I'm not assuming the loan. I'm taking the property subject to an existing encumbrance.
And in that situation, you're buying the house and you're agreeing to keep paying the mortgage payment, but yet your name and your credit is not being pulled for that. It stays on the seller's credit, correct?
Yes, that is 100% the truth. So
And,
the seller has a decision to make. You know, they cannot make the house payment today. They know that they can't get it sold. They know that the property is going to go to foreclosure. So really the only option for them to get it sold outside of foreclosure is option one. They find somewhere to pull $10,000 to $15,000 out of their back pockets to pay agents, commissions, closing costs, and any arrears that have accrued. Or B, allow an investor such as myself to come in, catch up all their past due payments, which starts getting their credit back on track, and I'll take over the credit, or I'll take over the house. The loan will stay in their name, but as I continue making payments on their behalf, their credit should stay clean, and they avoid the foreclosure. So really the question that the seller must ask themselves is, do I want a guaranteed foreclosure today, or the hypothetical possible foreclosure in the future if Daniel Moore doesn't make the payments?
and the reason you, Daniel, would take over this deal is why. So why is taking over, you know, typically we're told in buying any asset, we make money on the purchase, not on the sell, right? So in this example, you're buying a house that's value is at or equal to potentially even greater or less than what the mortgage is on it, right? So you take over this this mortgage. What is the benefit to Daniel to do that?
So there's quite a few benefits there, actually, and I'll take that house for 175 grand, but in the end, I will likely have none of my own capital in the deal, and I will likely make somewhere around $100,000 to $120,000. And this is through what we're going to call arbitrage. So what we're going to do is we've secured this, like, let's talk about this. Bank rates have been at historic lows for close to a decade now. The last recession, they tried to bail it out and stimulate the economy through lower interest rates. So we have massive amounts of low interest loans out there on the market right now. So this loan that I'm taking over is at $175,000 principal balance. Let's say they've got 2 years of loan payments paid into it, which is pretty much just interest if you look at an amortization schedule. But if I'm looking at that, I'm taking over a $175,000 principal balance for a home that's only worth $170,000. But the existing loan that's in place is at 3.5%, and it has 28 years left on it. Let's just leave it at that. It's a 3.5% interest loan. I don't have my financial calculator here on my desk. But what I'm now going to do is I'm going to do a market analysis, and I'm going to look at one of two things. And the first one I'm going to do is I'm going to look and find out if this particular property is in the line of gentrification. Do I see any possibility of a likelihood of a high appreciation wave hitting? Now, the scenario I just said the property dropped value of close to $30,000. So this property is probably not the fit. But the first thing I'm going to do is I'm going to analyze the deal and decide whether or not I feel like it's in a direct path of immediate appreciation through some level of gentrification. If it is, I will now hold the property in my personal portfolio as a rental, and I'll turn around and rent the property out, and I'll collect a yield spread between market rents and my underlying lien payments, my PITI payments. So I can cash flow it right there. And now I've just now accumulated a rental that will cash flow, and I haven't had to use any of my own debt to secure it. And now I've got a solid rental. Now, my hopes for this particular situation is gentrification continues moving through the neighborhood and expanding, and the property that I just took down for $170 within the next 5 years hits 250,000, hits 300,000, because gentrification says that it's moving my direction. But that's a rare scenario. So what I would do in lieu of that is I would also look at the market cycle I'm in. If I'm at the bottom of a market cycle, I'll take them all down subject to and rent them out and wait for the appreciation wave. I'm getting really deep in my strategy here. But the third, and the one strategy that will likely be applied to most people, is whenever I look at it, the market's depreciating. We're moving into an economic downturn. The property value is likely going to continue to decrease over the next 5 years, and it's not in the path of gentrification. So how am I going to pull 100 grand out of that house? What I'm now going to do is I'm going to turn around and resell the property. I'm going to find an owner-occupant buyer that is looking to move into this house that has at least 10 to 20% down. So if they've got 10% down, $17,000, I will resell them that property for, let's say, $185,000. Or to make the numbers perfect, I'm throwing numbers out there. I don't have a calculator in front of me. $175,000 is what I'm going to turn around is my underlying principal balance, right? I'm taking over $175,000 principal balance.
Right.
What I'll do is I'll turn around and sell it with a $17,000 down payment, which will recoup any of the arrears that I had to pay in closing costs. So all of the money that I put out to take the property down comes back to me when I resell it to this new buyer. Okay?
Yeah.
Now, once I have done that, I create a new loan with this end buyer. It's called a wrap mortgage. I will sell it to them for $175,000 principal balance, but instead of charging them 3.5% interest, I'll charge them 9% interest. So I'm collecting essentially a 5.5% yield spread between the underlying lien and the new lien that I've just put into place. So I'm now collecting 5.5% annual interest on $175,000 of essentially fictitious capital. You know, it's not $175,000 of my own money. It's existing money loaned by the bank. I'm wrapping that mortgage. I'm collecting a yield spread on interest, and I'm now cash flowing that as a bank loan. Essentially, I'm not a landlord. I'm not dealing with tenants, tools, and trash. I am getting predictive PI payments every single month. And what I'll now see is I'm collecting monthly income from a home that I have no responsibility for outside of the loan. And I now have collected over the course of a 30-year loan close to $100,000 in interest payments. That's the very detailed explanation.
And then if somebody wants to refinance the deal out and get a traditional mortgage themselves, they pay you off, you pay off the lien, and you keep the
I keep the equity,
the sweet butter in the middle, right?
Because what's nice about that, and it's hard to show you without an amortization calculator, but the underlying lien's at $175,000 with a 3.5% interest rate. So their principal balance is getting knocked away pretty fast compared to my 9.5% interest loan. So every single year, my personal net worth goes up because the yield spread between the underlying lien and my lien is different. So every year I create equity in my note. So if they do cash out, let's say in 5 years, I should get a substantial paycheck. Let's say it's $5, $10, $15, $20,000. The homeowner refinances into their own personal first position lien, and I no longer have my cash flow, but I have a lump sum of cash in my pocket at the end of their refi.
Well, to me, this concept of buying a house subject to their existing mortgage makes so much sense. Like we all know that the first couple of payments, I mean, here's an example, Daniel. I always love to be transparent, right? Just to show my ignorance for everyone who's listening to this to see. Today, I'm opening the mail at my house. My wife is a dentist. And by dentist, I mean homeschool mom of 4. But we still make the student loan payment on her dental school loans.
Okay.
Over the last, she's been out of dental school since 2006. So what is that? 14 years.
Yep.
For the last 14 years, we've paid $109,000 on those loans?
Principal and interest total.
Principal and interest. Guess out of how much of that 109,000 was principal. Right now, you're listening to this. Type it in the chat. I want to just see what your guess is out of $109,000 in principal and interest payments to the student loan company. How much of that do you believe was principal? Just put your number in there.
What was your interest rate?
4.625.
4.625. You've been paying it on 14 years. What was the amortization of it?
A lifetime plus 2.
Lifetime plus 2.
All right. So Joey says 25,000. Who else wants to put a guess in there? What do you think, Daniel?
So depending upon the amortization of it, but if it was like a 30-year loan, you're 14 years into it, 109,000 at a 4.25% interest rate, I'm going to lean towards probably about 30,000 of it went to principal. If that was a 30-year note.
A little over 14,000 has gone toward principal.
Oof.
Joy.
So, but here, I mean, again, there's pain in that, but also know that I've been putting capital to work and have out earned the 4.625. But here's the point that I'm making that you're making. I'm just reiterating in dummy language that I get is that now I make a $1,250 a month payment. $700 and something of that $1,200 is going toward principal, right? Because I've now gone over that hump and I'm starting to work my way toward it, right? Now, I don't want to put any more toward it. I'm good with where we are. But if I were going to go buy a house, would I want to start back where 50 cents of the $1,250 a month I was paying toward the payment is actually going to a principal? Or would I want to buy an existing debt where $750 of the $1,250 is going to payment? That's what you're saying. That's what you get when you buy an existing mortgage, right?
Pretty much. So whenever I take over that existing mortgage at more favorable terms, that debt gets powered down a lot faster than the new debt that I create for the new buyer. So every single time that buyer pays me and I pay the other loan gets paid down a lot faster than the one I created. And I'm able to create equity in that note as well as cash flow. Because whenever I got an underlying debt at 3.5% and I create a new debt at 9%, I'm collecting 5.5% interest on $175,000 that I never had.
And we're teaching that same concept every single day about how banks make money. They literally mark up. You deposit money in the bank, they mark it up and lend it out to somebody else and live off the money in the middle. And that's really what you're doing. You're finding deals that would cash flow from the mortgage that exists, and you're marking it up to someone else who then purchases it. You don't have to worry about the roofs or the toilets or termites or anything else, and you're making money just like a finance company in the middle. I love it.
Exactly. And like, it doesn't take you long to start making 5% on $2, $3, $4, $5 million. Because like, if you start taking over loans that are 200,000 a pop and you've got 5 loans, well, I take down 5 loans, I'm now making 5% on $1 million. I mean, that's pretty powerful. So I'm speaking on this on an advanced level, because I understand that many of the people watching right now might not understand this at an advanced level, but I'm not scared on speaking on it at an advanced level because there is 18 hours of education available on it in the Propelio Academy for absolutely free. So if this intrigues you and you're sitting here watching this and you're like, man, I have no clue what this man is talking about, that is excellent. That is why I'm speaking the way I'm speaking, because I don't want you to feel like you have a clue on what you're talking about here. The purpose of the education is to give you all of the details so that way when I am sitting here talking about arbitrage, yield spreads, underlying liens, all of these other items, that you're sitting there saying, okay, maybe I don't understand this. Let's go out there and watch this 18 hours of education that'll explain to me what all of that is.
Well, and if you're just now joining into this and you hadn't had a chance, if you go to wealthwithoutwallstreet.com/Propelio, you're going to see some of the things that we're talking about here, because Daniel has tons of different tools. One is an academy. One is also a tool that helps you analyze properties, helps you generate leads. So if you're in the real estate investing business or trying to get in it, this academy is giving you access to tons of things. But additional, you've got some tools here that help you kind of analyze properties and make these things. So how would I find a potential, like, so let's say I wanted to do what you just said. What are some best practices to finding the property, like find the person who is either about to go into foreclosure or who's looking to get out like this? How do I do that? How do I find that person? Are they raising their hand out there somewhere, or how do I know they exist?
Great question. So in addition to the subject to and wrap class available in the Academy, there's another class called pre-foreclosures. And pre-foreclosures speak in detail on how that process works. But historically, there's several people that really fit the mold of probabilities for these types of transactions. Anybody that's facing foreclosure that has no equity is a prime candidate for this type of transaction because they're behind on payments, they have no equity, and their ability to get the home sold is extremely limited. Like outside of them finding somebody willing to pay more than the home's worth, substantially more than the home's worth, and then being able to get a bank to loan the money at more than what it's worth, you're not going to be able to sell it. You're stuck. Really, your questions are foreclosure, foreclose. So it's really an open opportunity for when you have this type of transaction available to you to go in there, educate the seller on how this transaction works, and purchase the property out of pre-foreclosure. There are local and state laws that you do have to be aware of when you're dealing with pre-foreclosures and dealing with subject to transactions themselves. But all of that taken into consideration, really the homeowner's only option for getting out of this outside of coming up with $20,000 in liquid capital is to sell the property in this fashion.
Gotcha. All right. So we've hit on a couple of really good points, but here's one thing that someone might be asking themselves right now. I'm a real estate investor. Daniel's speaking on subject to and wraps as a way to make money in the potential down cycle that we're about to go through. Is there a type of real estate investing that I might be doing actually personally right now that's going to get hit the hardest? And maybe I need to figure out what that is so that I can avoid either getting into it or get out of it if I'm currently in it. What would that be?
I would weigh in caution for anybody right now that's flipping. Like your environment might not be bad right now. You're sitting here telling me, Daniel, I just sold a property for over asking value today. And I'm like, I'm happy for you. Like I would wish no harm on anybody. What I'm saying is that the environment is likely going to modify in the 24 months. I would say outside of the current government intervention that we've already seen, we would have already experienced massive catastrophic downfalls. But absent of future government intervention, we're already headed that way. So it's just a matter of how long this is going to last before it happens. So if you are flipping, I would stay within the lower third of your price points. I wouldn't want to be in the high end homes. The average homes have some fun, but they're also going to get hit. I would feel most comfortable personally in the lower income housing in that area. Not necessarily the super low end, but affordable housing is going to be prevalent always. And I consider lower income or affordable housing to be sustainable throughout this down cycle. Everybody needs affordable housing. So that's an area I wouldn't be nervous about being in. So if I am flipping, I would try to stay in that specific arena. And the reason I would also like to stay in that specific arena is it also provides multiple exit strategies. I would never in this particular economy want to put myself into a single exit where I have to take it, remodel it, and take it straight to retail. I need to have alternate exits, which means I need to be able to turn this into a rental. I need to be able to turn this into an Airbnb. I need to be able to turn this into a halfway house. I need to be able to turn this into an alternate exit. So that way, in the event that retail doesn't pan out for me, I'm not stuck filing bankruptcy. A lot of people that I saw go through 08 were ignoring all of the warning signs around them, and they're heavy on rehabs. They're sitting there with 10, 20, 100 rehabs on their books. The market shifted on them, and their only exit was retail when the retail market was collapsing. And you saw a bunch of people that took their net worth from 0 to 10 million and back to 0.
Wow. But I think that's the point that the Academy is giving people a different viewpoint on real estate, because a lot of times we get into something and just taking the step to get into real estate is big, right? If we've been, for lack of a better word, taking the blue pill, right, up until this point, and we've just been plugged in. It's just the easy way to do it. And all of a sudden, I said, I'm gonna step off a ledge here, and I'm gonna buy a rental property, for instance. And that is like a huge step for someone who has been doing it the typical way for so long. and then they don't realize that there's potentially traps in that in different market cycles. And so to be educated in different ways, or maybe like you did. I mean, I remember when we interviewed you, your first story into real estate was a flip, right?
Oh, yeah.
I mean, and imagine you had that success. You told one of your buddies, and they were like, I don't know about this, Daniel, but I'm going to trust you and I'm going to do it. And they happen to be stepping into that first one the day things go bad, right? I mean,
Right.
without knowing what to do, how to pivot, they would be stuck. And I love that about your academy, because it gives you so many different viewpoints on real estate. It's just not one way to do it.
Understood. And in close to 12 years of my experience in investing, I started when I was 23 years old, around 2008. Um, all of that taken into consideration, after everyone I'd been around, after any of the education I'd received, I had no one ever really break down a market cycle. What should I be doing? What market cycles should I be paying attention to? What acquisition and disposition strategies play well in certain market cycles? And in my opinion, the understanding of the cyclical market is the key to truly building long-term sustainable wealth in real estate. Like, you can definitely create a substantial net worth in real estate, but you can also lose it really quickly if you are unaware of how to work in different markets. So for those that have experienced for the last 7 years, 8, 9 years, a massive appreciation wave, that's not typical all the time. Like, we've gone up, but markets do this. And you need to understand, whenever the market does go this way, that you've got to shift, you've got to pivot. You can't just keep doing what you were doing. Otherwise, you're going to watch your net worth evaporate. While the market's going up, it's a lot easier to make money. Everybody looks like a king whenever you can buy a house and a year later it's worth twice what you paid for it. That's not a hard thing to do. But whenever the market starts going the other way and you start seeing your net worth decline, you need to know how to move away from that. Or if you're just getting in a market that's moving that direction, you need to know how to capitalize on a downward trending market. So I personally consider sub 2 wraps shorts to be the primary investing strategy on the way down. When you hit the bottom and you kind of flatline down there, sub 2 rents, not sub 2 wraps, sub 2 rents in appreciating markets, as well as burr in appreciating markets. And you stockpile that and you remodel them to the nines there, because at the burr method at the bottom, you can essentially acquire massive amounts of assets with limited to no money out of pocket. Because the asset values are going so low, I can go all in at 80 cents on the dollar in a buyer's market, and I'm not fighting to get those good deals, because the market, people will jump in when the market's at the top and they jump out when the market's at the bottom. It's complete and totally backwards. But when everybody jumps out at the bottom is when you should be jumping in as hard as you can, and you pull together a portfolio of assets that you own, and you hold those for depreciation against your earned income on the next appreciation cycle. You hold them for inflation, you hold them for amortization, you hold them for cash flow. And you shouldn't have any maintenance needs on them, because you completely remodeled them. New air conditioning systems, new hot water heaters, new roofs, fully remodeled homes, because now you can get the cream of the crop of their tenants, because they all just went through foreclosure, and you get to pick the best tenants that are now on a tenant wave because of the massive amount of foreclosures. I let those tenants maintain my property and pay for my property for the next 5, 6, 7 years of appreciation. And then once I see the top of the appreciation market, I take my portfolio, I run a risk analysis against it, I sell my portfolio off to capitalize for the next downturn. I can turn around and resell those properties and avoid real estate agent fees and avoid taxes and having to pay back all that depreciation by selling them off in packages of turnkey rentals to investors that have different investing strategies than I do. And then I can 1031 exchange that capital into a different asset class that's at a different market cycle. If you learn how to build your wealth through that way, not only will you be filthy rich, your children's children will be filthy rich if you pass that knowledge along.
And by the way, all the things that you just said are things that we could continue to learn repeatedly, right? Because yes, business cycles repeat themselves, but there's nuances, and we should always be learning. If you're listening to Daniel talk about this, the key in this that I hear is that there is education for us to understand how to be successful and to avoid the pitfalls. Joey?
Really?
Yeah, I got questions. I mean, you're going to let me talk at any point here, Russ, or what's the story?
You got the mic. Take off.
All right. So 2 questions. One, on the subject 2 front, what are the maybe top 2 or 3 reasons why it wouldn't work? Like, what are the things that you look for that, this is never going to work because of this? And then I have a follow-up question, somewhat related to our Airbnb strategy Russ and I are working on. So go ahead.
Okay. So on the subject to side, some of the key things that I'm looking for are what are the terms of the underlying lien. I don't want to take over ARMs, adjustable rate mortgages. Those can be killer. I don't want to take over something with a balloon on it because I don't want to run into that pitfall. I certainly don't want to take over a reverse mortgage, where I'm losing equity every single month. Those are the types of things I don't want to do. But the biggest pitfalls are things that are red flags with the seller. Like, this is a long-term relationship that I've now entered in with my seller. If I see personality traits of a seller that don't really play well into this strategy, like, I don't want to do business with anybody that's willing to do shady stuff. If they're sitting there trying to talk me into like, oh, well, if we just do this and we do this, and I now know that their mindset is thinking about doing things that they're not supposed to be doing. I don't want to enter into a 30-year relationship with that person. The biggest downfall in a subject to transaction is that relationship with the seller. And I don't recommend subject to being any strategy that a new person uses outside of some severe due diligence, access to a solid mentor, access to a solid legal team, and a well-capitalized bank account. If you are lacking those 3 things, I do not suggest subject to. Now, capital is something that you can outsource. You can go out and get private capital, so you have capital available to you. If you don't have it now, you can go out there and find it. The key things that you need to do a deal are time, money, and knowledge. So the Academy can help you out with the knowledge, but you're going to need a mentor on a subject to transaction. Keep that mentor in your pocket. You've got the knowledge, you've got the time, you've sourced the deal. And if you need the money, money's available, especially right now.
Gotcha. That's awesome. Thank you. So, all right. So Russ and I are working on an Airbnb strategy where we're trying to compile several of these. And I was just thinking through this. Our initial thought was that we were going to rent properties from landlords and then subsequently put them on Airbnb, of course, above board, letting everybody know the whole story from the get-go. But as you're talking, and we're at this point in the market cycle, might it be a potentially good way to think about taking them subject to owning the property and also putting them on Airbnb on the way down? Like, I mean, what are your
let's talk
thoughts
about
on
the
that?
advantages and disadvantages, because
Yeah.
there's advantages to both sides and there's disadvantages to both sides. One of the advantages of being able to take this down from a landlord and then subleasing it is that you have none of your personal credit tied up in it outside of that lease. And you're able to get into them quite simply. Like, you can go out and go look for listings available and talk to 100 landlords today and, nail down quite a few of them potentially.
Right.
There's a lot of benefits there. Some of the downsides to that particular strategy is you have no participation in potential future equity. You have no potential participation in principal pay down. You have no participation in depreciation schedules on your against your earned income through your tax benefits. So you lose the benefits of ownership, but you gain the benefits of scale rapidly. So there's some positives to the arbitrage, rental arbitrage model of Airbnb. Now, here's some of the benefits of the subject to side. Is on the subject to side is I do get all of those benefits. If the market's appreciating, I get to capture the appreciation as well as my income. I would potentially be able to make an extra $400 or $500 a month in income because I'm not paying the landlord their profit, so I'm able to secure that. So the benefit to the subject to side is I would do the subject to rental side at the bottom of the market. At the top of the market where we're at right now, where we're seeing a likely downturn of appreciation, you have to do your own sub-market analysis on this, is doing your particular model of doing the get it from the landlord and rent it out. Then you're not exposed to the market. If the market tanks on you, your equity doesn't disappear. I would likely save the subject to rental part for the bottom of the market cycle. Once we've already seen the massive amount of depreciation take wave, we grab subject to right there. And then I can hold those subject to, take on the appreciation, hold for the depreciation during that wave of appreciation, and then at the top of that market, sell it off to capture the equity, and then move back into my landlord strategy for the next wave down.
I love that. That makes so much sense, Joey. I mean, that is totally, once you said it, what I would want to do.
I mean, you don't want to be against the appreciation.
No, that makes sense. Well, I mean, we know that we're at the top, right? And whether the top was a year ago, or it was yesterday, or it's next week, we know we're much closer to a top than we are a bottom. And as we watch this thing ride down, you get down there toward the bottom. And again, nobody knows exactly where the bottom is until you look backwards after it's happened, but you know where it's getting close to. And that's
Yeah.
totally where I see, Joey, from our perspective, from the Airbnb model, to pick up some of those properties. And then, in essence, there's your flip. I mean, your flip is in, you already have an arbitrage that's making the cash flow. And then when you have an opportunity to capture some equity, you do it. And it allows you, like you said, to then scale back and go buy more rental arbitrage or do more rental arbitrage deals when you go back to the top again.
Yeah.
And one of the things that I love about real estate against other asset classes, like you can make money in anything as long as you're applying sound business principles to it and you're understanding, where the opportunity is. But the thing that I love so much about real estate is that our cycles are typically a decade or so, somewhere between the low side of 7 to 12 years, or typically where we're seeing our past 5 swings at. With that taken into consideration, it's not minute by minute. Like if I'm trying to go out there and day trade, I've got to be in and out of trades in a matter of seconds, and you have to be really sharp to time that. To time the real estate market doesn't require that same level of genius. Like you can ignore it for 3 months and come back to it and be like, yep, it's still doing the same thing. And you know what? The things that I like to look at is I like to look at average home prices versus average income, and average rents versus average income and stuff of that nature. And whenever I chart all that together, like you can very clearly see where the last boom hit. It started right after the repeal of Glass-Steagall when the lending environment got really jacked up. And that right there spurred on the next wave of appreciation. You can see where it took off and you can see where it popped. And if you start applying just some basic technical analysis to those charts, I would likely jump back into this whenever I saw the home prices hit at the previous support levels, which was right where home affordability hits with the average income. So that's what I'd be looking at to jump back in on the market.
Gotcha.
So I want to, if we can, we've got about 10 minutes here to wrap up. Do you mind hitting on some of the key points of the software that you offer through Propelio so that people can see, I'm going to take the step into real estate. Give me the equipment, give me the tools to be successful. Besides just the knowledge of the strategies, what do I do from there?
Absolutely. Like I am hands down not ashamed to say that we provide, in my opinion, as well as the opinion of a lot, and I think it's very easily debatable with facts, more value than any other software company out there. Some of the key things that Propelio provides is access to nationwide property data. So like what I can do with that property data is show me, like one of the things that I know about subject to is that most people that we do subject to with are been in their loans between 3 to 7 years. So show me all property owners that have owned their home for between 3 to 7 years that have limited to no equity in them and are a 3-bed, 2-bath newer than 2013. Well, I know that's a prime property for me to go after on the subject to side. And then I can add another filter on there and then show me all the properties that meet that data. And then also show me the ones that are in pre-foreclosure. Well, I've just now got a list of all the prime people that will likely sell me their property subject to. So Propelio has a close to 144 million properties in their database, and with massive amounts of filters to apply against them. Wow. So unlike other list providers, most list providers limit you to about 5 to 20,000 property leads a month from those databases. Propelio offers 150,000 of those a month. So when we come to your access to data, Propelio hands down provides more data than any company that I know of. So beyond just the property data, we give you access to national MLS comps. So one of the key things that you need to be able to do as a real estate investor is understand what the value of the property is. If you don't know what the value of the property is, it's very hard to determine what your all-in price is going to be, what your expenses, your profit's going to be. Right. So access direct MLS comps 24 hours a day, 7 days a week instantaneously is bar none an absolute necessity for any real estate investor out there. And then I take those two key features, which alone sell for $100 each. I also throw in two other things. I throw in the ability to come in with no technical experience at all and get in there and say, you know what? I need a website to create some credibility for my company. So that way, when I'm sitting down with a seller, I'm not sitting there saying, hi, I'm flybynighthwholesaler@gmail.com. Well, with Propelio, with no technical experience at all, in about 5 to 10 minutes, you can have a professional website set up with your business that can have yourself your logo, your professional emails. So you know Daniel Moore at ibuyhouses.com versus Daniel Moore at gmail.com. It adds a layer of credibility there, but it also gives you the ability to start doing some digital marketing through driving traffic back to your website. So you get the nationwide lead list across 144 million properties. You get access to MLS crops across the nation. You also get access to your full-blown websites, unlimited websites. And on top of all of that, even more value, I give you access to a mobile app for your phone to assist you in driving for dollars. You can skip trace property owners. What do I mean by skip trace? You're sitting out in front of a house. You're like, that house looks pretty messed up. It's obviously abandoned. I can pull open my phone, tap the property. It'll tell me who the owner is. I can skip trace and find out what their phone numbers are, all their potential phone numbers, who their potential relatives are, the phone numbers of their potential relatives. I can also send them direct mail right there from my phone. I'm sitting there looking at the house. I can take a picture of the house. The picture of that house will go on a postcard and be be mailed out to that homeowner right there in the front yard. Like I'm on the front yard, 5 seconds later, I've got a postcard going to that homeowner. I can skip trace that homeowner, give them a phone call and be like, hey, I'm sitting out in front of your house right now. I noticed it hasn't been mowed in a couple of weeks and somebody busted out the front window. Would you happen to be interested in selling that property? I'd be glad to buy it from you. Those types of things are the things that Propelio does for you and gives you an edge up on the competition through the software we provide you. Now, all of the software we provide you is available independently from different providers, but no source that I know of provides you all of those tools in one spot for the same price that we provide. Other people provide a single tool for.
Wow.
So good.
Can you show us visually like what one of the websites looks like?
Yeah, I sure can. Like, give me a second. Let me cut over to my computer. Boom. Give me just a second to get that fired up here. But like if I come over here and I go into propelio.com and let's just say I log in over here. When I log in, let me get this set up here.
I'm putting you on the spot, Daniel, but you know,
Oh no.
I think it's great to see what you're talking about.
All right, so I come in right here. So right now I have 144 million properties that I can run against. I don't know if on y'all side from this, if y'all side, y'all can blow up my screen, or I don't know if y'all can or cannot do that. But what I'll show you right now is I'll type in an address. And I'm just going to type in a property that I've owned, 2703 Colleen Drive, Arlington, Texas. All right, so from right there, what that's going to do is it's going to immediately pull up all the public records that I can find about that property. I now know that Cody Waddle and Crystal Brown own this property. It's a 3-bed, 2-bath, 1,600 square foot, built in 1975, lot acreage, lot size. I can see the estimated value of the property up here in the top right-hand corner. Estimated value $213,000, and there's estimated $104,000 of equity in that property as of right now. These are all estimates based upon public loan documents and stuff like that. But I can find out all the tax information about it. I can come in here. I can click on it. I can really quickly look around, see what's going on in the neighborhood. I can see what's going on from a visual standpoint. It's like, okay, that's where it's at in the metro area. But beyond there, I can scroll down. All right, property characteristics, land info, building size, mortgages and transfers. All right, they just recently took out a loan from Supreme Lending. So we can find that out and we can see when the last deeds were transferred. We can figure out all of that information. But what happens if I need to run comps? Well, I can come up here and click on the comparable sales tab. And up here on the comparable sales tab, I can say, okay, here are all the sold properties nearby. I can click on this one. All right, this property sold for $94 a foot, listed at $130,000. No photos of that property available. All right, what about this one over here? Boom, another one sold for $135,000. Definitely a as-is property. This property was not remodeled at all. Well, I can come over here, I can adjust characteristics, I can do all of those types of things. So that is just touching on what Propelio can do. And you were asking about the websites. If I come over here, I click on websites, and come down here, I can say, go ahead, let me visit this site. I don't know if this site's been customized at all. This is just one of my default test accounts, but this is what my website would look like. Now, obviously you'd be able to upload a logo here instead of just having a typewritten name up there, but I haven't uploaded a logo on this site. But you can see here, this is what my website would look like if I was to be a Propelio customer. And this takes about 5 minutes to get you up and going. And this is a proven system that works for closing on, motivated sellers. So we've got all this here available for you, and it's all in one spot at one simple price.
Wow. And what is it cost for people to get involved with this software?
So for everything that's there, which includes the comps, the nationwide property data, the Driving for Dollars app, as well as the websites, it's $98 a month without contracts. There is no contracts. There are no setup fees. There are nothing like that. You can come in and pay $98 a month, and you have access to all of that. Now, to put that into perspective, there are companies out there that have a Driving for Dollars app, and they charge $100 a month for their Driving for Dollars app. There are other companies out there that sell websites, and that's all they sell is websites, and they charge $100 a month for their website. There are other companies that sell nothing but property data, and they sell it for $100 a month. So really, we're giving you like $400 a month worth of tools for a $98 price point. And that's why I say arguably, and I would defend it with statistics and data, we provide more value in the software space than any other company that I know of.
So let me wrap up at least one of the things that I'm taking away from this conversation. And Russ, I'd love your thoughts as well. So someone's listening to this today, they've never done real estate. They can go and get free education through the Academy on subject twos. They say, okay, Daniel says we're on a down market or decreasing market. I'm going to go learn about subject twos, wraps, and short sales. Then I'm going to go and for $98 a month, I'm going to buy into this tool that will help me source the very thing that I just learned about for $98. And the strategies that you're talking about specifically, let's just call subject twos, literally can take very little to no money out of my pocket to get started. So now I've created a path, and I'm tying this all together with our community. I want to get into real estate. This is my path. I'm going to start down this path, and I don't have to have virtually anything more than $98 a month to create a path that could lead to, as you mentioned, let's say I had 5 properties at $200,000. I'm earning potentially 5.5% on $1 million in less than a year.
Yeah, that's very doable.
Absolutely. Does that fire anybody up?
How long would it take you to save $1 million and go put that into a hypothetical bank that would pay you 5.5%? Right? I mean, think about that. Like what you could create. Yeah. I mean, for some people too.
So my personal mentor from 2013, which was when he got started on the subject to side, up to about 2017, he added about 130 to 140 properties into his subject to portfolio. And if you look at, let's just say the average acquisition of one of those being $100,000, he's got close to $13 million in notes that he's collecting probably on average of 4 to 5% interest at. And then he's got the equity that's capped into that as well. So, what I have seen, and this is not a guarantee by any means, is most people that persevere and commit to real estate and they stay consistent with it. Consistency is a key piece to it. Persevere, stay consistent with it. Most people that do, and they last for about 7 years. 7 years is about the mark where I've seen most people become a financial net worth multimillionaire.
Well, and I also love that this is something that people can do on their own time. Like if I'm working 9 to 5, but I'm looking for a way out, this is something I now have access to the data and the education that I can do this after hours. I can do it on the weekends until I've created enough passive income cash flow that I could say, hey, I'm out of here. I love this.
It's most definitely doable. Like I've done it myself. Like I feel confident in saying it's doable and not feeling like I'm being a soapbox salesman, because I've done it myself. I've seen many other people do it themselves. And like I did a live training for free. I don't pay for I don't pay to train people. I don't do mentoring. I don't do anything like that. I did a free mobile home class on Facebook about a month ago. And I've already got one lady, she's a social worker. She makes about $45,000 a year. She's supporting her family off of $45,000 a year with her kids and everything else. She watched that class, has already gone out and purchased 3 mobile homes, and she's got a passive income stream right now of about $1,200 a month off of those 3 mobile homes that she's got about $6,000 in. So she's about $6,000 in, pulling $1,200 a month in cash flow out of these things. And I guarantee you within a year, she'll be retired. And it's strictly because she believed in it. She took action on it. She didn't make up a bunch of excuses. And within a month, she's already out there kicking ass. She's done 3 deals in just that amount of time.
I love it.
That's awesome. All right. So go to wealthwithoutwallstreet.com/Propelio and take Daniel up on this free academy. And if you're looking for a tool, buy it. Get after it. Daniel, it's been awesome. Thank you again.
Thank you, guys. Thank you both.
Hey, Daniel, do you mind just staying on just for a little bit?
Sure.
Once we're going to close out here, but do you mind just sticking around just for a minute?
Yeah, most definitely.
Awesome. All right. Thanks, guys, for being on. We really appreciate it, and hope you got a lot of value out of it.